If you had your choice between buying and holding a 30-year bond for 30 years or holding a basket of American stocks, there's just no question you're going to do better holding stocks. So it's more attractive considerably more attractive than fixed income securities. That doesn't mean they're going to go up or down tomorrow or next week or next year, but over time, a bunch of businesses that are earning high returns on capital are going to beat a bond that's fixed at roughly 3% for 30 years. And it's not my field of specialty, but actually they look, stocks generally, which are their businesses, they're American businesses, 30 trillion worth of them, and they look cheaper than generally real estate.
Is that the only thing that makes stocks look attractive right now, is the comparison with fixed income?
Well, that's what you have to do in investing. I mean, you're sitting with some cash in your pocket, you've had savings, and the question is, what do you do with it? You can buy a duplex next door and rent it out to people and do fine over time, or you can buy a small piece of farmland or something of the sort, or you can put it into something fixed income, bonds or bank deposits or whatever it may be. And stocks, if you look at American equities, American businesses earning a lot of money relative to the capital put in. And the reason stocks are worth a whole lot more than they were 20 years ago or 50 years ago or 100 years ago is companies have plowed back part of the earnings. With a bond, you get it all out in interest. You know, you get your 3% or whatever it is, and that's what you have. With stocks, you get maybe a 3% dividend, but they're plowing money back, or they're repurchasing shares or doing something. And over time, that just makes a huge difference.
The last time we talked to you, you said you were still buying stocks. Are you still right now?
We're buying stocks this morning, and I'd rather buy them cheaper, but I've been buying stocks since March 11th, 1942. And I bought them under every president, 7 Republicans, 7 Democrats. I've bought them quarter after quarter. Some of the buys were terrific. Some of them were at such good times. And I don't know when to buy stocks, but I know whether to buy stocks. And assuming you're going to hold them, wouldn't you rather own an interest in a variety of great businesses than have a piece of paper that's going to pay you 3% in 30 years, or a short-term deposit that pays you maybe 2% or something of the sort?
Yeah, no argument. Although your concentration in the stocks you own has gotten a little more concentrated recently. There was a filing that came out not too long ago that showed Berkshire Hathaway was continuing to buy shares of Apple. It's now, you own 5% of the shares outstanding of Apple. It's the biggest holding for Berkshire Hathaway at $56 billion. Have you continued to buy even since that filing?
We bought just a little. I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century, and then since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company; it's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way, because costs really matter in investments. If returns are going to be 7 or 8%, and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
All right, now let's discuss how we can use monthly paying dividend ETFs to supercharge our wealth by the compounding power. Now, I went through several ETFs, tons of ETFs, to pull out these top 3, which I think are the best for me at this time. The number 3 on the list is ticker SPHD, which is the Invesco S&P 500 High Dividend Low Volatility Portfolio ETF. The ETF has assets of $3.06 billion and has returned 12.19% over the last 5 years, which to me is a very interesting performance. Now, looking at the dividend yield, we'll see a 3.47% dividend yield and a 0.52 5-year growth rate. I do love the growth rate to always be positive. Checking out the expense ratio, we'll see a 0.3% expense ratio for this particular ETF. And looking at the sectoral allocation, we'll see the bulk of the investments are in the utilities, consumer defensive, and healthcare sectors with 20%, 18.5%, and about 14% respectively. The various stocks that make up the top 10 holdings of the ETF are again in these particular sectors. So by and large, this comes in as number 3 because the yield is quite decent at 3.47% thereabout. It has returned positive returns over the last 5 years, and it also has a growth rate and a fairly decent expense ratio. The number 2 ETF on this list is ticker DHS, which is the Wisdom Tree US High Dividend Fund. The ETF has 863 million under management and has returned a whopping 24.93% over the last 5 years. Checking out the dividend yield, you'll see a 3.25% dividend yield and a growth rate of 4.76% over the last 5 years, which is quite impressive for me. With an expense ratio at 0.38%, which is slightly higher than what we saw in the previous ETF, this ETF's expenses is higher, but again, I like the growth story compared to the other ETF. And checking out the sectoral allocation of the breakdown, we'll see allocation to healthcare, consumer defensive, and financials having the top 3 slots in this ETF. It's no wonder that we'll see names like Pfizer, ExxonMobil, Philip Morris, Coca-Cola, and the likes in this ETF. Alright, so this ETF comes in as number 2 because of the 5-year growth, the dividend yield, which is decent, and also the dividend growth, which I think is phenomenal at 4.76% over the last 5 years. Now the number 1 monthly paying dividend ETF on this list is ticker DIA, which is the Spider Dow Jones Industrial Average ETF. The ETF has a whopping 29.05 billion under management and has returned a staggering 70.24% over the last 5 years. Now the yield on this ETF at 1.72 is quite lower compared to the others, but the growth rate over the last 5 years more than compensates for that at 5.15%. One of the sweetest spots for me for this ETF is the low expense ratio at 0.16% compared to the other monthly dividend paying ETFs. I love the expense ratio to be low because over the very long term, like I always say, the expense ratio adds up. And finally, for the sectoral allocation of the holdings breakdown, we will see the financials, healthcare, technology, accounting for the biggest allocations, with very familiar names like United Health, Goldman, Microsoft coming in among the top 10 in this. Now let's just do a summary of these 3 ETFs so that you guys can really see where I'm coming from. Remember, these ETFs pay dividend monthly, and so that's a paycheck you'll be getting every month. But for me, the DIA stood out as the number 1 ETF for several reasons. Number 1, the asset under management is bigger compared to the other 2, which speaks to the comfort folks have in investing in this ETF. Again, over the last 5 years, the fund has grown by 70.24%, which is significantly higher than what we can see for the other ETFs. Now, the dividend yield comes out as the lowest, but however, with this capital growth, it more than compensates for it. Checking out the dividend growth over the last 5 years, it's clear that the DIA also posts the best dividend growth over the past 5 years. And from a fee standpoint, to add again, the lowest fee already shows us that less will be taken off the eventual returns made on this ETF. Now looking at the sectoral exposure, I love exposure to finance, health, and technology, which is a real blend of growth and value investments. So by and large, the DIA remains the best ETF for me at this time. To wrap up the video, I would like you to hit the like button, subscribe to the channel, and leave a comment on which of these 3 ETFs are your very best ETFs. With that said, thank you for stopping by again, and I will post another video comparing some other ETFs for your viewing pleasure. Thank you for watching, and see you all in the next video. Cheers.